If there is one man that the entirety of the financial world listens to without any second thoughts, it is Michael Burry, a hedge funder who is known for the big shorts, made a series of tweets in the past week that highlighted some really interesting but what could be really worrying series of thoughts for us. If you were just about to open your Twitter and check what it is, there is no point in doing that because Burry has already deleted them. It will not be surprising if some of you already saw what we are talking about right now, but maybe the importance of it has not dawned on you yet. And for those of you who have not, we've got everything from what those tweets were to what it could mean for us right here in this video, so stick with us to the very end. Before we do get into what those tweets were, let us just have a look at exactly how many times Michael Burry has hit the bull's eye. It will not take much to remind you about the 2008 housing market collapse, right? Well, out of the very few investors who predicted it word by word, Michael Burry was one. And damn, he did make some very good profits out of that. Since then, Burry has been on the front line for many more stock market games the world has seen. Remember the GameStop crisis during the pandemic? Did you have any clue that Michael Burry was one amongst the many who paved the way for the GameStop boom? He also went out of the way by betting against Elon Musk's Tesla and Cathie Wood's flagship ARK fund last year. Of course, all of this did cause a lot of people getting stacked against him. You know how it works. Elon Musk, for example, even called him a broken clock, but the Twitter war is a whole story for another day perhaps. What we are here to talk about are a series of tweets that Burry deleted which raised a recession alarm. If you are already aware of the market, you are already aware that a recession is happening. Since the past 5 years, the S&P 500 has dropped more than 12%. Just over the last 6 months alone, the blue chip index is down by a hopping 21%. That is nearly double the number in 1/10 of the same amount of time. Now you might be wondering that is probably the worst it could get, right? But it does not seem like it. Burry's tweets warn that there could be even more pain ahead. Adjusted for inflation, 2022 first half S&P 500 down 25 to 26% and Nasdaq down 34 to 35%. Bitcoin down 64 to 65%, he tweeted. That was multiple compression. Next up, earnings compression. So, maybe halfway there. Did that go over your head? Not to worry, we are going to break it down word by word. Right at this moment, the S&P has shown its worst first half performance since the 1970s. At this point, if Burry is correct and the S&P 500 has another 25% fall ahead of it, the index could drop as low as 2,800 this year. That is a number we have not touched at all yet. Although it is a number that Michael Burry did predict back in May, he had argued the S&P 500 could sink as far as 1,862, based on a historical analysis of past bear markets. Thankfully, it did not, but it did get worse. In a way, Burry was indeed correct. What really makes us worried is that it is not just Burry who is ringing alarm bells for the stocks. Another prominent person who has predicted the fall is George Ball, chairman of Sanders Morris Harris, a Houston-based investment firm with $4.9 billion in assets under management. Bell told Fortune that he sees the S&P 500 falling to 3,100 this year. We do not believe the stock market has bottomed yet, and we see further downside ahead. Ball said, the Federal Reserve's aggressive but necessary inflation-fighting measures are likely to depress corporate earnings and push stocks lower. As an extra blanket of assurance, most Wall Street experts seem to agree with this. Just last month, a survey was carried out by the Deutsche Bank that comprised of more than 475 institutional investors and other market professionals. The results were quite interesting to note. 72% believe that the S&P 500 will hit 3,300 before it rises to 4,500, and 90% now see a U.S. recession by the end of 2023. By now, you might be convinced of one thing: a recession is happening, whether we like it or not, and it is only going to go downhill from here. So only two burning questions remain. 1, why is this exactly happening? And 2, how do we save ourselves from it? Let us start with the first one. In the tweet series that Burry came up with, he said that the widespread investor apathy marked the bottom of previous market downturns. Such was the sign in 2002, 1932, and 74, he said. Once the pandemic was over, we were all expecting a major economic boom, right? Then what went wrong? Where did the inflation and recession come from out of nowhere? Apparently, many things did not go the way it was supposed to go. In response to alarming inflation, the Fed has raised the federal funds rate substantially this year, including back-to-back 75 bps hikes after meetings in June and July. This has been the most aggressive hikes since the 1990s. How does this affect the economy? It is simple. The higher the interest rates rise, the more expensive it becomes for U.S. companies to borrow money to invest in innovation and growth. Add rising credit card, mortgage, auto loan, and other interest rates, and this reduces the disposable income Americans must spend in the economy, which weighs on the corporate earnings and stock prices. It is a way to quash the inflation by slowing down the economy, but clearly has backfired on us. Another sudden factor that has influenced this sudden market plummet is the Russia-Ukraine war. The supply chain disruptions in Asia and economic sanctions against Russian oil and gas have acted like a fuel to the fire. The Personal Consumption Expenditures Price Index has risen 2% over the Fed's preferred measure of U.S. inflation. Last but not the least is the yield curve inversion. If you know how financial markets work, you would also know that this is perhaps the most assured trend of a recession. Inverted yield curves have historically been a strong economic recession indicator. The current yield curve inversion that we are seeing is the deepest since 2007, the year before the global financial crisis. Alright, so at this point we might have scared you quite a bit, but as they say, there is always a greener side. While there are a lot of people who have predicted the stock market plummet, there are also a lot of people who do believe we might just avert it somehow. Many economists say the economy is simply too healthy now to consider current conditions a recession. At this moment, even if we do slip into a recession, it is not really a reason to panic. Why are we saying so? Just look at your history. For starters, recessions do not historically last very long. The average duration of a U.S. recession since World War II is just a bit over 11 months. We do not even need to go that back. Let us just look at what happened a year back. The COVID-19 recession in early 2020 lasted just 2 months. Another happening that might calm you down is that recessions are common. Even if you have not experienced it on a personal scale, we have had at least one recession every 5 years since World War II. What we are saying is that there is a good chance we might pass over this. You might have also been familiar with the concept that recessions can lead to job losses and other financial difficulties, right? Well, let us give you another view again from the pages of history. We are agreeing that recession can be difficult for investors to figure out a market bottom perfectly, but it also comes up with excellent buying opportunities for long-term investors. So if you stick to your portfolio and make no sudden decisions, us and perhaps most of the economists will agree that you will be fine. So what you're trying to say here is that even though a recession is the last thing we could expect, it does have a silver lining to it. Recessions, by driving down asset prices, can also provide opportunities for attractive returns for long-term investors. So just stick by the basic principles of investing and enjoy the money compounding over a long period of time. If you love the video, make sure to hit the like button and do not forget to subscribe to our channel. Do you agree with Burry's predictions? Or do you believe it is just another false alarm? Let us know what you think in the comment section below because we love hearing from you. We will be back very soon.